Hi, everyone. Welcome to the Yes Investment Club. This is the second chapter of the Advanced Investing course. And this chapter will focus on the types of investing. So you must have wondered how Rakesh Jhunjhunwala made a staggering growth from rupees 5,000 in his pocket to rupees 20,000 crore of net worth. Or it may be how Warren Buffett became a successful investor at such a young age, right? So this chapter answers this question by discussing the investing methods that you can use depending on your profile and the market scenario. And the syllabus for this chapter is first we'll cover the growth investing, then it is value investing, then we'll move on to passive investing, then we'll cover active investing, and then we will move on to what is the difference between trading versus investing.
Okay, so first you can begin by talking about what intrinsic value is. So intrinsic value is the intrinsic value of a stock is essentially the actual value of the stock, which is determined with including factors like financial performance, revenue, earnings, cash flow, and profit data. So intrinsic value means not just looking at what the stock is listed on and its price, but also looking at how that stock will develop over time, its financial performance in the past, and intrinsically guessing or estimating what the actual value of the stock is.
All right, now to types of investing. We'll briefly cover many different types as well as explain how they're used in the market. So for this chapter, we'll be covering growth investing, value, passive, and active investing. All four types, we will elaborate on some of the methods that common investors use. And now we can begin with growth investing. So Philip Fisher is one of the most prominent growth investors that we know of. And one of his quotes was, "I don't want many good investments. I want a few outstanding ones." And so we will explore this quote in terms of growth investing just to show how prominent and powerful it can be if employed correctly. So when it comes to growth investing, we have to keep four things in mind: its definition, how it started, the types of growth investing, and how you can identify when you can invest and try and do growth investing yourself. So what is growth investing? So it's basically a type of investing that prioritizes stocks that have demonstrated a track record of high or emerging growth. And it's considered an offensive strategy that looks for stocks with growth potential in the short term or the long term. However, this strategy follows the principle of high risk and high reward. Because even though, let's say, the stocks have performed well for a given period of time, there's no guarantee that they'll continue performing at such a high level. There's always the chance that they may decline in value or they may fall in value because the market is volatile. And so the only way you can growth invest safely is to place your bets on something that's performed consistently over many years. And you can say by yourself that, hey, this company is stable enough that I can invest in it for its growth. And so that's what's the meaning of high risk and high reward with growth investing. You don't have any guarantees, but you do have some kind of assurance when it comes to returns on your portfolio. Before we begin with the types of growth investing, let's talk a little bit more about Philip Arthur Fisher, because most importantly, he's considered the pioneer in growth investing strategy. He's the one who's come up with the types, how you can growth invest and how the average investor can growth invest. And so let's talk a little bit more about him. So he was a businessman who dropped out of Stanford Business School all the way back in 1928. He's most well known for starting Fisher and Company in 1931. And he also authored a book called Common Stocks and Uncommon Profits in 1958, which is where he highlighted some of the methods of growth investing and how he found success with it as well. So moving on to the types of growth investing, obviously there are two main types, the short-term investing and the long-term investing. So long-term investing usually occurs when investors choose to hold the stock over a long period of time, usually I would say 3 to 5 years, as they believe that the intrinsic value of the stock will go up and reach a good value around that time. And so what that basically means is over a period, like I said, of 3 to 5 years, they believe that the stock will perform very well and they believe that the price will go up significantly. So therefore, they choose to hold on to it. And it's essentially another very high risk, high reward situation, because in the long run, nothing is fixed. The prices is not fixed. the guarantees of the company are not fixed because technology changes and everything changes. So investors just assume that the company is going to perform well, and therefore they believe that it's going to increase in value. On the other hand, short-term investing, as the name suggests, is basically when investors choose to hold the stock for a short period of time, usually anywhere from 1 to 3 years, if not shorter, as they believe that the intrinsic value of the stock will go up and reach a good value around that time. And one thing to keep in mind is 1 to 3 years is not considered the set value for short-term investing. Some may consider the short term to be as short as 1 month, while others may consider it to be as long as 1.5 years to 2 years. And so they just believe that since the company is already making strides in the present, it's likely that they'll continue growing for the next, let's say, 6 months to a year. And therefore, the stock value is going to go up because of that development. So just a few graphs to show growth investing. If the stock price is moving upward, it means that it's outperforming the market. If you see Google, if you type out any stock that you can think of on Google, you'll tend to see a graph that shows you the performance of a stock over a given period of time. You have options ranging from 1 day to 5 years. And if you see a positive trend constantly, which is that the graph is in green, it means that the stock is essentially moving upward and it's outperforming the pace of the rest of the market. In complete inverse of that, if the stock price is moving downward and you see that the graph is red in color, it means it's underperforming in comparison to the market. And on top of that, it's losing value over a given period of time. And one more thing I just want to add, when it comes to risk, it depends on the time you're holding the investment in, because as you hold the investment for longer, it's likely to become a little bit more riskier, mainly because a lot of things change over the years, especially for a company. It may go through new administration, new executives. And so there's no guarantees that the company will always perform as it was in the past. And so things can change in the long term a lot.
Right. Okay. So let's start with the second type of investing, which is value investing. So we will cover the definition, give an example, the brief history, the views, the fundamental views of the value investments, and then we'll talk about certain topics such as intrinsic value, margin of safety, and long-term investments. So what is value investing? Value investing is an approach that revolves around selecting stocks that are undervalued. And the idea behind investing in such companies is that when the market goes for a correction, it will correct the value of such undervalued companies, and the price will then shoot up, leaving the investor with high returns when they sell it. Right. So let's look at the example of people who are into value investing. So the first one is Warren Buffett. He is the CEO of Berkshire Hathaway, and he is a student of Benjamin Graham, who is considered as the founder of value investing. And he uses all his strategies based on value investing. So because of that, he is able to grow his portfolio value over a period of time. Second person is Benjamin Graham himself. He is known as the father of value investing, and he used to invest in stocks which were massively undervalued during that point of the market. And the third example is Seth Garman. He is a famous American billionaire investor, and he manages funds and HNI portfolios. HNI stands for high net worth individuals, and he does his investing only on undervalued stocks, right? And he is known for giving high return on investment because his research strategies are really precise as to identify which stock is undervalued and how much time will it take them to grow, right? But there's always a factor of risk, and even though they are professionals, they also incur a loss, right? So it's mandatory to know that a stock market is a play of gains and losses, but you can hedge your losses by doing good research and evaluating which investing methods you should use. So let's see the brief history of where value investing started. So the value investing actually is explained really well in the book called The Intelligent Investor, which was written by Benjamin Graham, who is the founder of value investing in 1949. And one quote that summarizes the entire book is that an investment operation is one which upon through analysis promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. What this is trying to say is that the investment should not be speculative. It should be well researched, and you should know what and why are you investing in the stock, right? And if the principal amount, the value that you have invested gives a return, it is an investment, right? If it does not, you're just speculating the market or guessing the market will grow, and then investing, right? So the first learning is that value investing must be done intelligently, because it should be supported with detailed research and analysis. And second learning is that the focus of value investing is to avoid capital losses and generate adequate returns instead of attempting to pick high risk investments with a low probability of generating returns. So the three fundamental values or views that you have to undertake or understand to do value investing is, first is underestimation. The stock has to be undervalued in the current market, and you need to support it with research by looking at the ratios that we have taught in the basic course. And if you feel that the company is undervalued and will perform better in the future, then you should invest in the stock, right? So underestimation is the first key principle. Second is overreaction. So what this says is, when the market corrects itself, every investor will overreact to the price and the price will get corrected automatically, because the market will get a sensation that the underestimated stock deserves the normal value and it should not be underestimated, right? So that's why the people will react on that, and this will rise the stock price. That's the second key principle view. And the third is fundamentals. By fundamentals, I mean you should understand why the company is holding strong and why it will grow. What are the business avenues or sectors it will probably open in the future, or what are the profits will gain in the future, right? So you should stick strong to the fundamentals, and your fundamentals can differ from other investors. Like certain investors look at who is the owner, how many holdings does he have, what is the private equity ratio, etc., right? So you have to consider these three principles of underestimation, overreaction, and fundamentals, and then you get a grasp of how to do value investment. So let's talk about what we learned in the start, intrinsic value. So for value investors, they believe that the price of the stock should match the intrinsic value in the long run, which means the price of the stock right now should match the actual value in the long run. And so if the price is less than intrinsic value, then the price is then the stock is available at a discount, which means that it is good and you should invest, and it will serve as a value investment later on. And for measuring these intrinsic values, you can look at earning per share, price earning ratio, the price to book ratio, and the PEG ratio. Now let's look at margin of safety. So margin of safety is again a concept of value investing itself, but it talks about the difference between a stock's current market price and its intrinsic value. And that's what the actual definition of margin of safety is. So for example, if a stock is currently trading at rupees 100 and its intrinsic value is rupees 95, then the margin of safety of the stock will be 5%, right? But this is a cliched example wherein it's just a small margin of safety. Most of the value investors seek a margin of safety ranging from 30 to 60% when selecting investments, right? Because they look at how much growth can the stock offer and how much can they bet against the stock so that the growth can happen and the actual value can be achieved. So when the margin of safety logic is applied, it has to represent the potential upside for an asset. And if the intrinsic value calculations are correct, the stock market price should reach that particular price at a given amount of time. So that's margin of safety. But moving on to the long-term investments. So because value investing is a type of long-term investment, it is considered to be quintessential for the investor to understand this. So it may take many years for the market value of the stock to match its intrinsic value, and value investing requires the people to be patient and wait for the correct value. And by waiting, value investors give the market sufficient amount of time to actually recognize the actual value of the company's stock. But without being patient or without waiting, you can't actually achieve value investing, right? So patience is the key to achieving success as a value investor. And the legendary investor Warren Buffett said this quote on the next slide, which is, the stock market is nothing but a sort of a device that transfers money from the impatient to the patient. What it's trying to say is, because of value investing, the impatient people just sell the stock off, and the patient people wait for the stock to achieve the actual value and then sell it off, right? So they'll achieve more profit. So as value investing requires picking investments in a calculated fashion, a successful value investor can never follow a herd mentality, because he has to think differently. So it is important to for the value investor to be good at research and be patient, and he should not engage in speculation, because by speculating he's not applying his knowledge, and by researching he is able to apply his knowledge and understanding so that the investment can succeed. And it is very rare to come across this combination of people who are investors, who are like patient, are good at research, and are not speculative. So very few people very few investors actually engage in value investing as a type of investing method.
Right, now we'll be looking at passive and active investing. And so first we'll be looking at the definition of passive investing. And so what passive investing essentially is that it has the goal to build wealth gradually. So it's kind of like the long-term investing. And so it involves less buying and selling, but rather holding the stock, and it lets it grow over a period of time in order to get a return on the investment. And so by income investing, they receive their income through the return on investment given by the growth of the stock. And active investing is that it has the goal to earn money quickly. And so in contrast to the passive investing, where it was gradually, it has the goal to earn money quickly. And so it involves frequent buying and selling. And it gets its income from squaring off and booking profits as time passes.
So now we can discuss the overall differences that we can see between trading and investing. There are quite a few, so we're going to go over that now. First, one quote that kind of summarizes the differences between trading and investing is a quote from Benjamin Graham, who we did discuss before as the father of value investing. So he said that in the short term, our market is a voting machine, but in the long term, it is like a weighing machine. So his intention behind this quote was trying to say that when trading, it is a lot more dependent on short-term gain and short-term loss. Whereas in the long term, when you look at things like investing is much more like a weighing machine, where there's a lot more nuance, a lot more volatility in the market a lot more factors that you have to consider when making your investing choices. So let's go a bit more into detail about what these differences really are. So for example, the first is the investment period. So a lot of trading happens short term, with buyers and sellers looking at second or minute differences between prices to buy and sell stocks. Investing is much more long term, because they want to generate returns over longer periods of time, such as between 3 to 5 years, because waiting for that much time will allow for much greater profit. As that moves on to the next point, because need for profit for investing is slower, but it generates a lot larger profits, whereas for trading, it is faster, but generates smaller profits. Frequency also plays a role here, because trading requires a lot more real-time decision to be made. It is much more frequent and happens a lot faster, whereas investing is a lot more cautious and therefore happens a lot more rarely. Fluctuations in the market also affect investments versus trades differently. So trading is a lot more sensitive to short-term fluctuations because of the real-time aspect of how they trade their stocks, whereas investments are much less affected by small fluctuations over time, because the real goal is to try and generate a positive return over the course of 3 to 5 years. So as I mentioned, like risk profile also plays a very good importance in the difference between trading and investing, because trading requires a lot more risk, because it is based on very short-term changes, whereas investing usually has a much lower risk because there's a lot more cautious, a lot more research, and a lot more fundamental analysis done before conducting an investment. Talking about fundamental analysis, we have the types of analysis that are required for both trading and investing, where trading requires a lot more technical in-action analysis of the stocks in the given time, whereas fundamental analysis for investing is a lot more cautious, takes into consideration a lot more factors, and therefore is able to make smart decisions about what investments will be worthwhile. Examples of both for investing, of course, I've spoken about Warren Buffett, but for trading, we also have examples like Jesse Livermore, who is a prominent trader in the space.
So that's all. Thank you so much.